Good evening, everybody. My name is Michael Johnson, and I am super excited to be here with all of you this evening. We have a great presenter and expert in the field of insurance and financial matters, Mr. Justin Voss. I've been looking forward to this all week because I know he's going to be giving some awesome information. So I would love everyone to take copious notes because I know that this is going to be a real educational benefit to you. So without further ado, I'm going to turn it over to Mr. Justin Voss. Justin, welcome.
Thank you very much, Michael, for that great introduction, and thank you for hosting tonight's event. It has been a real pleasure to continue to work with you. I know we did this also back in April for Financial Literacy Month, so it is a great honor and a privilege to work with you again. If anybody happens to be in the market looking for real estate, or even better, as we continue to evolve into solar and solar power, there is no one better than talking to Michael here about it. You know, as the automobile industry continues to evolve and as we move into electric vehicles, and shoot, if you're located here in Southern California, like Michael and we are, we just went through, a very lengthy heat wave, which the power grids were certainly put on heavy task. And having that ability to have solar panels up on your roof reduces the impact. I know personally here in my own house, we'd had several nights of rolling blackouts, having to go back out and reset all the clocks and the computers and the stove and the microwave and all of those parts and pieces there. It took a little bit of a toll on us. So look, as we continue to move into the electrical world, if clean energy, there is nobody better than talking to Mr. Michael Johnson about your needs for solar. So again, Michael, thank you for all you do, and thank you for presenting us on this evening. It is an awesome privilege to be here with all of you guys here tonight. I thank you for joining us here Thursday night at 7 o'clock. I know you probably had some other places that you would rather be, but you're here with us tonight. And so I hope to show you some value and to give you some awareness about why life insurance is so important, not only to you personally, but for your family and your generations to come. So, one of the things I want to start off with this evening as we roll into the presentation is I'm going to tell you some stories. And every story that I tell you this evening is a true story. This happens. And I have a few that I'm going to share as I continue to talk about life insurance awareness and the things that happen. And the first story I'm going to tell you, I work a lot via LinkedIn. I'm in the business networking, environment. Michael is as well. And I happened to come across a young man who was part of my network who had posted on LinkedIn and asked for some help because his brother-in-law had suddenly come down out of nowhere. He went immediately into stage 4 lung cancer and only had a very short amount of time to live. His particular prognosis had developed inside of his lungs and then spread throughout his body. So he was really, with a very short window to take care of all of his priorities. And certainly the man fought to the very end, but he had a wife and 2 small children. And, as I come to speak with my friend here via LinkedIn, you find out that he had no life insurance. He had no real health insurance in order to cover the extreme costs of going through the operations of trying to get this mass removed out of his lungs and the chemotherapy. And it was just a sad thing to say. And here was his brother-in-law, in the process of trying to hold it together and to be, supportive of him and his family, that he ultimately died. And they needed a GoFundMe page in order to help facilitate that. And so the stress that it put on him, because now he's taken on kind of the responsibility of taking care of those 2 young children and his wife, who is just destitute without him. So without further ado, we're going to talk about life insurance and why it is so important. And I'm going to share my screen with you tonight and cover some of these incredible things. And let's make sure we start with the current slide. Thank you so very much. Here we go. So again, September every year is Life Insurance Awareness Month. And for everybody to get out to the know, life insurance has evolved over the years. It is not just what you have thought it should be, like your old mom or grandma used to say, well, we got life insurance back in the day and, we paid for it all the way up until the end and it's come and gone. Well, life insurance has evolved since way back when. There are actually 5 types of life insurance that everybody should be aware of. There is term or temporary or even group type insurance. There's whole life, universal life, variable life, and the big one at the end, indexed universal life. And we're going to kind of run through these. But being in this particular financial field industry, we notice that, majority of Americans are underinsured. And so you ask yourself the question, why? Well, really, it comes down to knowledge, really, and an understanding. If people had a better financial education, they would have a clearer picture of how today, in the 2020s, how life insurance has changed and evolved. It's not just, I pay for this, I die, and I get money. It's changed. So we're going to run through the first one. We're going to talk about term life insurance. Now, term life insurance typically is exactly what that means, is that you are buying a block of time set up for whichever type of death amount that you wish. Typically, it's 10, 20, or even 30 years. Now, temporary life insurance as well is also done through your employers. A lot of you may be working through a job and through your corporation where they offer a small amount of life insurance. Those are group policies. They are temporary policies. They do not last forever. So by chance, if you should be laid off, retire, or resign, from your position, that life insurance goes away. So it's important to know that temporary term, right, or group policies that are with your employer are only temporary. They can become extremely expensive after the term is over. So if you have purchased a term policy for 10 years, after that 10 years, that normal, really leveled premium that you had been paying is going to jump considerably. So keep in mind when we talk about term life insurance. Now we're going to move into permanent life insurance, and usually they call this whole life, where the premium goes to the death benefit, and then you develop a little bit of a cash value that starts to develop inside that life insurance policy. These policies are been around the longest out of all of them. Whole life came before term, actually. So really in the late 1800s, whole life was really the first insurance policies that came around. And around the 1920s or so, then we came into term life, where they started to offer smaller amounts, smaller premiums in order to cover more. But in this particular case, whole life is designed to cover your entire life. So you're going to pay the premium from the day that you sign the contract all the way until the day that you die. But it also doesn't mean that it's guaranteed, right? There are not guarantees in all of whole life. So if you happen to have some issues with inside the policy, it's not specifically designed properly, there is a chance that it could lapse. Okay, so we talked about a small cash value. Typically, these are very, very small. It's about 1%, 2%, depending on the carrier that you have. So you get a small amount of residual income as it starts to develop inside these ones. Some whole life policies are really designed to last about 30 years as they're constructed. These are really kind of old thought processes now that usually work with these. And expenses, went higher between 1% to 3%, and they can start to deplete the cash value as the rates and expenses inside some of these older policies take effect. These also run into problems if you happen to stop paying the premium or you decide to take some of that cash value out. Some of that cash value is in there. It's also there to help protect against the premiums that are generating inside. So that's whole life. And there are a few other subcategories of whole life too, like when we talk about expense insurance as well. These are part of whole life policies, and they're specifically designed for that particular purpose. So we're going to move on from here. Now, as time evolved and we came around to the 1960s, right, life insurance again took a step forward and it decided to evolve itself. They created something called universal life. Now we had the ability to take all of the benefits from whole life, take some of the benefits from term, and we put it into something called universal, where now we could have adjustable premiums, right? We could actually start to configure these policies in order to gain better value out of them. Now, the cash value that's developing inside, so part of the money that goes to from your premium goes to the death benefit. The other half goes to the cash value. Now, because it's a much better improved product, the cash value increases as well, normally about 3 to 5%. And if these things are properly funded and designed, they should really last you your whole life. So universal life policies are still current today. People do generate universal life type policies today. But it's also a great idea to have these older policies reviewed annually to make sure that your premiums and your policies are running in line, and so that you don't run into a lapse situation. Because the many reasons why policies lapse is because people are really anxious to get in there and grab some of that cash value, or they stop paying against the premiums. Not to mention that, look, interest charges can start to creep in there, once you start depleting those policies of some of that cash value. So you got to really watch out for these particular ones, how they're set up. But universal, right around the 1960s, was developed. And again, life insurance continues to evolve today. So from there, as we move forward, we're going to move forward about another 10, 20 years. As the life insurance starts to evolve again, people started to say, well, hey, look, instead of putting some of that cash value developing in whatever account that the insurance company has for you, why can't we link that to the market? Oh my gosh, we can now start investing into the stock market. So variable life has been set up as well. It's very similar to universal life, meaning that it has adjustable premiums and policies and can be converted and set up specifically to the client's needs. These are tied directly to the stock market. So when the market is booming, as we were for the last 18 years, where we had this tremendous bull run, unfortunately, since 2022, our market has dropped. So you get all of the potential gain of being in the stock market, of having huge gains in a bull run, but you also have to be able to contend with the market when it drops, as it has dropped now. And certainly the market has dropped more than 25% since the beginning of the year. So the value that you have inside of that policy, if it's tied directly to the death benefit or the cash value, takes a hit in that as well. So that is something very, very specific, and a very qualified agent has to be involved with setting up with these because of the securities options that are involved with them. When you set these things up into mutual funds or to specific stocks, you need to make sure that the agent that is helping you is a qualified agent. Okay, now coming out of the 1970s, we're going to progress into the late 1980s, early 1990s. And now again, as life insurance continues to evolve again, we have just made it better. We have made it better, and we have now made this thing to do so many things. We've taken every benefit we've had for the last 75 years, and we have now pushed it all into a product that is what we call in the financial industry, the Swiss Army knife of financial tools. Now, here are the amazing amount of benefits that go into an indexed universal life product, right? Again, premium goes to the death benefit and to a cash value. But now, instead of having smaller gains, 3% gains in the market, now you're getting significant returns. You're getting 5 to 8 average interest, okay, on your cash value. That is very similar to 401ks. The average 401k over the last 20 years averages the same amount, between 5 and 8%. Those are tied to the market, right? This particular product is not tied to the stock market, unlike a 401k is, right? So what you have in a lot of these particular products is you have a floor of 0. Should the market fall below 0 and go negative, the cash value that is inside this product stays in the positive. Normally, the floor is probably about 0.75, right? And then the insurance company caps you at a growth of between 12 and 15%. So you stay locked in to positive gains all the time. Now, if you take that into consideration when you're talking about a 401k, which is tied to a market, tied to a fund, as the market dips, you are participating in those losses. But having your money tied into an index universal life product means that you are safe from market loss. Let me say that again. You are safe from market loss. And the great thing, one of the other great benefits about this is that there's zero interest taken if you decide to take money out, if you decide to take a loan or withdraw from the money that develops inside of that. That's huge. Not to mention the rule of 772 in the IRS states that money that is inside a life insurance policy is not considered an asset. It can never be taken away from you, not by the government, not by the courts, not by anything. It is not an asset. But everything that's accumulated with inside there has a benefit of no tax. So the death benefit that's paid out to you or to your beneficiaries, or the cash accumulation that you absorb inside there, is a tax-free benefit. And we'll cover a lot more of that as we continue to roll through Index Universal Life. Now, people say, well, I really want to invest in the market. I want to be able to get gains in the stock market. I don't quite need this thing. Well, that's exactly what this is. This is an investment tool. This is a tool designed to not only grow wealth inside of it, but also there to protect you and your family, right? Many people nowadays, certainly the 250,000 and larger incomes, corporate level, right? The rich use this as an investment tool because they don't like risk. They don't like risk in the market, right? They don't want to pay taxes on any gains, right? Your 401k is a tax deferred product. When you go to claim the money in your 401k, you are paying taxes. However, cash accumulation inside an Index Universal Life has no tax, right? And let me tell you, what is the number one expense that everyone, regardless of where they're at in wealth, what's the one thing that they hate? Taxes. Incredible. Let's move forward. So let's recap what an IUL is, right? It's a Swiss Army knife of financial tools, right? It's a powerful vehicle to protect you and your family. In case you die, your family's protected. It has the ability to protect you from illness, and we're going to talk about this in a little bit too, called living benefits. It offers you the opportunity to save money for your retirement. So having long-term growth, okay, sustaining no market loss, no tax, right? It's an asset that can never be touched. And business owners, right, use this today to build and protect their business, right? And also offer it as key employee retention programs. That when designed properly, the cash accumulation can be used for loans, for your retirement, college funding for your kids, right? Anything you want it to be. All designed specifically for you inside this particular product. Now, a lot of these things are sometimes in the news. If you're a football fan, right, as we now entered into football season, right? Michigan Wolverines head coach, Jim Harbaugh, right, was famous because part of his compensation package was a very, very hefty Index Universal Life product that the school gave to him. It's in the news. You can take a look at it. You can take a look at how his product has been structured, right? Because of all of these features and benefits, right? The no tax, the no market loss, the accumulation to be able to protect you from illness, right? And to be able to protect your business and your assets and your family. That's what this is really about. So, I had a friend, a colleague that worked with me here in my firm. And he was in the firm probably about, only a few months. And fortunately, he didn't stay long. He was a very sharp guy. He was into finance. He was into stocks and trading, and was very successful. He made probably about $250,000 a year trading stocks and was done very, very well for himself. When we took him into the firm, we decided to say, just like we do with everybody that comes into the firms, we give them a financial needs analysis and we set them up with an insurance product, and showed him something just like this. He was a young man. He was in his early 20s, and he unfortunately he declined. He said, "No, it's okay. I'm good. I have, I make a pretty good amount of living, and certainly, I'm well taken care of. And about a year later, he welcomed his first child, a little girl, a beautiful little girl. And he was on vacation. He lived in Colorado, and he was on his vacation in Florida. They had driven down to Florida to go see Disney World and so on and so on. So they took a road trip and had a beautiful time, and was amazing and wonderful. And as he was driving home, he developed a blood clot in his lung and died. Just like that. Now, if you're the wife and the daughter, you are now in the middle of nowhere. And having to go through that process it's just catastrophic. Well, he had nothing set up for his family. So the amazing amount of money that he made, his $250,000, basically ran out, and now his family is destitute. She wasn't working because he made all the money. They are no longer able to pay for their home. He made all the money. She now has to move in with her parents and has nothing set up for themselves for the rest of their lives. And yet here's a guy, extremely smart, made $250,000 a year, nice living, but wasn't protected. And so now his young daughter is going to have a difficult life without his dad, without her dad. And that's a real shame. This is a true story. And this just happened recently, within the last, 6 weeks, I believe it was. So important to remember why this is so important. Okay, let's talk about the cash accumulation that happens inside these index policies, right? So if we take a look at the first graph here on the left-hand side, this is kind of what our stock market has looked like over the last 6 months. You're going to see this whole mountain range going up and down and up and down and up and down, right? So if we take a closer look at it, you'll see the market goes up and then the market drops, and then the market goes up and the market drops, right? So you're never getting any type of stability out of the gains that are happening in it. What you're having is gains and losses, gains and losses, gains and losses. However, as we talked about earlier, inside an indexed universal product, right? This is how it works, right? As the market goes up, you take in all of the market gain, right? And if you look at the first lock, you see that's the gain. Now, when the market drops, if we looked at the indicator below, as the market drops, you are now level. You are stuck at zero, right? Or in this case, the floor, which normally is right around 0.75. So you're always making something. And then as the market continues to gain again, as you can see, the market went back up again, you gain again, and then it locks you in. And then it goes across nice and flat again as the market drops, right? This little bitty haggard line. Then market goes back up again, you're gaining all the way through. So you are never ever having market loss. You're only gaining inside. Now, for you and for me, safety in the market is a premium, okay? You got to be able to do market risk, right? The loss of impacts. And let's just talk about how this impacts work, right? So if you had $100 in the market and the market drops 50%, right? You lose half of your money, right? So if you lose 50% of your $100, at what rate does it need to return for you to get that $100 back? Well, if it goes back up 50%, you don't get your whole money. You're only getting back 25 cents, $25 on the 100 that you lost. The market needs to double in order for you to get back to that $100 mark. It needs to gain 100% in order for you just to recuperate what you lost. Now, calculate that with your sums of money, with your 401k, your retirement, or your investment inside of there. And I don't know about you, but I like security. I like safety. I don't like taxes, and I don't like loss, especially as we evolve and we get a little older. Maybe one thing for a young person to be able to say, hey, you know what, I'm going to go through a couple of down markets in my lifetime because I'm relatively young. I should be able to sustain that. Well, what if I told you, like, you don't have to sustain anything? You can run right through the market and only get gains out of it. And there are ways to do that. And through that particular product is one of those ways. Now, let's talk about taxes. There are two things in life that are sureties. We're going to die and we're going to pay taxes. That is a fact. We're going to die and we're going to pay taxes. So where do you put your money? Right? If you put your money in, a savings account or a CD or a money market, you're going to get taxed right away. Now, the government was nice, right? They came up with these plans, right? It's called a 401k, or in this case, a 403b, or a thrift saving account, or in this case, an IRA, right? Where they're deferred taxes, where you're going to put your money in there before it's taxed, have all the gains long term, right? Because these are retirement accounts. You can't touch them until you retire. So if you're 30 years old, right, you can't touch them until age 59 and a half or 65, depending on where you wish to retire. When you do, the government comes in and says, okay, thank you very much. You've held on to all this money. Now it's time to take it back. We're going to take our share. Now, what if I told you that there was a never tax advantage? Well, you have the Roth IRA, in which you're putting money into a Roth, right, which you've already paid taxes. It's a post-tax contribution, right? But it's also a retirement account. So, yeah, the money that gains inside there and whatever fund you wish to put it into is non-tax, and that's nice, right? Depending on what you put it into. You have a 529 plan, which is a college plan, right? Non-taxable, right? That money must go towards college funding, right? And then you have the Universal Index Life, which all the money that goes inside of that, all that accumulates is non-taxed. So let's kind of recap a little bit, right? If we take a look at a traditional IRA, right, or a traditional 401k, right? So as we talked about before, you don't put any, your money that goes in there is not taxed, is pre-tax. Usually your employer, right, will then draw your money out and put it into your fund for you. Then the rest of your pay is then taxed. So you have tax deferred growth, 100% taxed contributions and gains on all withdrawals. Excuse me, anytime that you go and touch this money at retirement, the government comes in and takes it out, right? You have to wait until you're retired. You touch it early, you're going to get a penalty and you're going to pay taxes on top of that. However, structured into a proper index universal life product, the money that accumulates inside of that product is zero taxed. So let's take a look at it. If I have $100,000 in my IRA and I have $100,000 accumulation in my index universal life, okay, I can't touch the IRA until I retire. Then the government's going to step in and take 30% normally, right off the top. So my 100,000 is really 70, okay, because I have something set up in this index universal life product, right? My $100,000 is $100,000. I can take a withdrawal out of that anytime I want. So if I need to pay for my son's college, if I need to pay for a wedding, if I want to give him a gift, if I want to use it for my retirement and sail around the world, that is available to me to touch anytime I wish. Now, which one of these would you rather have? We already discussed earlier that the rates of return are generally the same. Your traditional 401k averages between 5 and 8%, right? Your index universal life over a 20-year span averages right around that as well. Has no market loss and only gains, and is not taxed and is not an asset. Pretty simple stuff. The difference between, having knowledge and not having knowledge is only what people tell you, what you've been communicated with, your friends and your family. I would venture to say that most of your HR department in your corporation or your work really can't tell you the difference between all of this as well, which is why it's so important to be able to have, a professional sit down, develop a plan, find out what your needs are, and help you get to where you want to go. So I've given you two stories tonight about two tragedies that have happened to families, and they're real. Well, I'm going to give you another one. This one has a little bit of a better ending. It's tragedy, but it's still there. A family that I knew, I was gracious enough to be able to help them. They got a couple of smaller insurance policies through me, right? Because they wanted to have protection for themselves and their families. They have two girls. The husband gets up very early and drives to work. And unfortunately, he drives a motorcycle, right? That was his love. That was one of his passions. Well, he got into a car accident and died. Killed instantly. Now, because we set him up, we set his family up, the death benefit paid out about $500,000 to the family. Now, you can never replace the father that should be in those kids' life, the husband that should be there for his wife. But, you know, through the gracious of being prepared, she was able to take that money and give her girls an amazing life. Now, one of the things that she's done with it is that she set up not only for herself, because we increased and upgraded her life insurance policy, but we also got two of them, two different IULs for her kids. Now you ask, why would you do that? Well, the younger that you are, the less inexpensive these policies become. It's only through procrastination that the cost becomes considerable and probably out of a lot of people's minds. But if you do this young, you are locked in. It can never go up. It can never change. And again, what you have is time to accumulate money inside of this particular policy. She got two of them for her children at a young age. And by the time that they go to retire, right, through this policy, she set it up so that she'll be able to pay for college tuition, pay for the girl's wedding, right? Possibly even set up a down payment on their first home, right? And have a little bit money left over for some sort of retirement fund towards the end. She used the program that we call in my firm the $1 Million Baby Program, and we set her up with that. She also took some of that money and she invested into another insurance product, which we'll talk about another time. That again, safe from market loss, been averaging about 19.3%. And when she goes to retire, she will have a little over $8 million in her account to pass on generational wealth, not only to her daughters, right, but for generations to come, right? Because they made a decision to protect their family, right? Because we don't know when tragedy is going to strike. And that brings me to living benefits. Living benefits is a rider, okay, that can be added, and some of the larger insurance companies are able to offer this particular rider or attachment to there. And there are three components that we're going to cover that are added to them, right? Usually at very, very low to no cost at all. The first one is a chronic illness rider, okay? Chronic illness meaning that you are unable to perform two of the 6 functions of daily living, right? As we get older, you know, chronic illness is going to kind of take its toll, right? So the 6 activities that they're chronically illness that are referring to are bathing, dressing, using the bathroom, right? Toiletry, eating, incontinence, right? And then transferring. So without the assistance of another person, if you are severely impaired, right, for 90 consecutive days or more, you can then accelerate the death benefit in your life insurance policy, right, in order to pay for your living conditions, right? Because I'm assuming that you can no longer work, right? Unemployment's very limited, right? If you talk about disability pays next to nothing. And how are we going to sustain the medical cost that it's going to take in order for us to continue to live? Well, when you're including the direct cost associated with the loss of economic productivity, right? The total cost of a chronic disease in the United States is $3.1 trillion almost 20% of the country's gross domestic product, right? All happening because of chronic diseases, right? Incredible. So protection against chronic illness is one part of living benefits. Now, too far, let's go back here, pardon me. You know, what can happen to you? Chronic illness affects many people, right? And creates additional expenses. So if you happen to be chronically ill, you know, my mom, you know, is chronically ill, and thank God we were able to set her up with living benefits when I did her policy. The cost of nursing homes to put your mom into a home or your father into private care, right? You know, that averages between $6,000 and $10,000 a month, right? So $75,000 a year just to care for yourself or for a loved one, right? With home aid, the national average is about $3,600, which translates to $43,000. We're going to get old, everybody. And we're going to get sicker as we get old. And how important is it to be sure that you are prepared for that? And what happens, you know, most of us are going to run through our life and we're going to have some sort of critical illness, right? Every one of us or is going to know somebody close to us that is going to suffer a heart attack, or they're going to have a stroke, or they're going to have some sort of cancers, internal and melanoma, right? Some sort of failure, or need some sort of organ replacement, right? Or suffer from diabetes. Diabetes is going to kill us alone. Or the paralysis of having two or more limbs because of a stroke. These are going to us. The burden of being able to, you know, put that onto your family, right? But if you are protected, right? And that you have something like living benefits so important to attach to your life insurance, you can accelerate up to 90% of the death benefit while you are alive. So as your mom and pop used to say, oh, when I die, you get the money. Well, what if I have a stroke and I can't move half my body and I can no longer work and I can no longer provide for my family? How are we going to live? How are we going to survive? Would $500,000 help you out? Absolutely it would. Cost is minimal. Costs nothing. 42% of new cancer patients lose their entire life savings within the first 2 years of treatment. Surgeries, chemotherapy, after surgeries, chronic care, all of that. This is a fact. It's better to be prepared than not be prepared. Difference between knowing and not knowing. Knowledge is power only when it is applied. And then we have terminal illness. If you are diagnosed with a short time to live, much like my friend was via LinkedIn, he could have accelerated his insurance policy and have his final arrangements set up to take care of his family. The services, the cremation, his remains, his 2 children, his wife, and their well-being critically could have saved them. So that's living benefits. Chronic, critical, and terminal illness riders attached to your life insurance can save your life. It can save your family's life. It's not just a death benefit that when you die, you get money. What happens if you live? You can't do some of those things that we just discussed. And then lastly, as we kind of continue to roll through this, my last story that I'm going to tell you is a personal one. 2 years ago, my father passed away suddenly. He died of a massive heart attack. He was 69 years old. Being in the financial industry, in the financial world, I came to my dad years before he passed away and said, Dad, come, I want to make sure that you're good. Let's sit down and take a look where you're at and what you're doing, And he, said, no, I'm good. I got it all good. I'm good to go. Thank you, son. I don't want to bother you. I want you to live your life. Dad is good. Dad is fine. Until you get that phone call that I got. I live in California. My father lives in Massachusetts. So I got a call from the state trooper saying, Mr. Vaz, your father has passed away. So in the middle of my grief and in the middle of having to get my family together, fly 3,000 miles to take care of my dad, right? To take care of his affairs, to find out exactly what he had set up. Come to find out, he had nothing set up. He had nothing. So in order to arrange his funeral and his burial, my father was a veteran. Thank God the Veteran Society came along and helped, but he had nothing. In order to close out his accounts and to settle his estate, my father had no beneficiaries, nothing set up, and I was his son. Now, because of all of he said he was good and I'm fine and to take care of his estate, 2 years later, I am still closing out accounts because I had to go to probate court in Massachusetts, deal with it from California back and forth. 2+ years later, it is still not finished. Life insurance isn't just about a death, right? It's many things. And we talked about some of those things today. We talked about it as, yes, it is a death benefit that can take care of you and your family. It has something to take care of you when you're sick and you're unable to work anymore and you're unable to function, right? And we look at it as an investment as well for our futures. What if I don't have any of those things? What if I never get sick? What if I never have cancer and I never have a stroke and I live a full life? Well, then you have a solid investment, right? Because these are 9 things that life insurance can do for you. It can protect your loved ones. It can provide you with financial reassurance that it's going to be good. You could be the Neo in your family. You could be the one to change the arc of your family's history. It could be there to help pay off debt, protect your business. I'm a business owner. It could be there to help protect my business, right? I could use the money that I accumulate with inside the IUL to help pay for my son's college, right? I have already set one up for him so that dad has just set him up for his own retirement. My son is 8 years old. The rule of 72 says he's going to have 60+ years of compounding interest inside this account. 60 years. He got it when he was 5 years old. Before he does anything with his life, before he becomes the man that he's going to become and the family he's going to have, he will be taken care of. And his family and generations to come will be taken care of. Help you in your retirement. What would you rather have? A 401k where you're going to pay taxes, you're going to be limited to get your hands onto it, or you want something that you're going to have tax-free and can help you, right? As we discussed earlier, it can help cover year-end life experiences. We're going to be sick. It's going to happen. It's inevitable, right? So as we talk about estate planning, right? Plan for your estate. If you've got multiple properties, right? If you're buying properties from Michael Johnson, right? These are assets in your community. Life insurance comes in and helps you aid in your estate planning. If you're a charitable person, right? And you want to give to charity, it could be there for them as well. Features and benefits of life insurance have changed and evolved over the years. It's not your mom and pops anymore. It is an investment tool for your future. So, to sum up, proper protection, income for your family, long-term care and disabilities and living benefits, and helps you with your estate and your assets. Okay. Now, real quick, the enemies of wealth, right? An IUL, your insurance, is a financial tool. Every wealthy businessman, millionaire, billionaire, whomever, right, that deals with finances, right, and wants to build an empire, wants to build a future, right, he does not procrastinate. He is going to be protected from premature death and illness, right? He's going to save. He's going to limit the amount of taxes he pays. Inflation is not going to affect him. Market loss is not going to affect him, right? And we have the tools to combat all of those enemies of wealth. That Swiss Army knife that I spoke about this evening, that is an important tool that you need to have in your toolbox. So, one last thing, 401ks, okay, you're going to get taxed, limited access to it. Pensions, you think you have a pension, 78% of pensions are funded, right? Only 78%. They can be canceled, they can be minimized without you knowing it, right? IRAs, Roth IRAs, SEP IRAs, all have tax advantages, but they come because they're tied to the market, right? And there's a lot of restrictions. Mutual fund stocks, great when the market is booming, bad when it's down. Real estate, everybody should own real estate. Talk to Michael Johnson, right? Real estate market, if you own real estate, always going to be in demand, right? Living benefits and cash value in life insurance, huge tool. A tax-free retirement, definitely. Secondary income solutions, non-asset classes, right? Like your insurance policies, non-assets. Take the time to learn about new tools and evaluate where you are often. Speak with a financial professional quarterly, yearly at the latest. And take a look at upgrading your life insurance. What you think you got, speak with a professional. Not every company offers the best products. They can only offer you what they have. But after today, you've learned that there are 5 types of life insurance. Ask questions. Be proactive. Do your due diligence. Learn about living benefits. Learn how these can increase your income and save money for you in the long run. And then again, we talked about the benefits, the death benefit, choices of choosing which index you would like your money to be put into, the choices to be able to have your cash value, the additional optional benefits like living benefits and long-term care can be added, right? And lots more. So that is the end of my presentation. Thank you very much for allowing me the time to speak with you guys tonight. I hope that I have provided some value, gave you some critical insight as to how life insurance is and works today, and how powerful a tool it can be in your toolbox if you use it well. So, Michael, there you are. I can take some questions if you like from the few of us that are here. I know that there was some mail in. Here is my contact information if anybody would like more specific information. Again, the floor is yours, Michael. Thank you very much.
Justin, that was just outstanding. Outstanding. I took notes. Wow, just amazing. So I do want to open up the floor for any questions at all. This is your opportunity, and please take this opportunity to drill this man. He's a wealth of knowledge. This is your time to ask any question that you might want to ask them. So open up the mics and any questions. All right, I have a question for you, Justin. Can you describe the process of taking out a college loan out of an IUL?
So absolutely. So as you have accumulated cash inside an IUL, right? You have the ability to make a claim against some of that cash. You can say, hey, look, I have $100,000 in there. I would like to withdraw $20,000 for college tuition. You can contact your agent, who will then contact the insurance company, and they can set up the forms in the claim process in order to facilitate that. But absolutely, you can. That's a simple explanation. But and again, see your agent, and then talk with your agent. That way you can have that ability set up for you. But absolutely, you can.
Okay. Veronica would like to know, how old do you have to be to have life insurance? That's a great question, Veronica.
I mentioned inside the chat that I'd set up insurance for my 5-year-old son. There is no real restriction. Now, there are some contingencies in terms of how much that you can claim or you can put as a death benefit. It's all tied into your particular policy, your son or child. But 5 years old, he was able to get one.
Awesome. Awesome. Any questions? Any other questions? Let's keep it going. Okay.
Well,
if there are no other questions, great questions, great session. So what I like for you to do is to, oh, wait a minute, we have one more question coming in. And this is a great question here. How do you change from one type of insurance to an IUL? Great question.
Again, there are laws pertaining to the ability to maneuver and change your policies. The law basically states that you can only go up in changing, right? So if you want to come from a term into an IUL, we could certainly do that because we are stepping up. Unfortunately, you cannot step down because these are contracts. The state of California mandates that you can only improve the contract. You cannot devalue the contract. But you can move from one to the other. Some companies allow you to change from a temporary policy into an IUL. But again, speak to your representative, your professional. You can certainly book a call with me, and we can certainly talk about it specifically.
Awesome.
You're welcome.
All right. Absolutely. Anything else? Okay. Well, if there was no other questions, what I will do is I will send out the recording to each and every one of you for joining. Also, because you were able to join, we're going to send you on a 4-day, 3-night Vegas stay. I pay for the room. You guys pay for the taxes. And just for coming in and joining in and listening, this is a very real thing. It's no gimmicks. There's no timeshares. There's nothing. Just want you to go and enjoy and think about your life insurance and your next move. So Justin, thank you so very much, my friend. You're awesome.
Thank you, Michael.
Beautiful job. And we look forward to doing this again real soon. And everyone have a great evening and God bless. Bye now.
Great. Thank you very much. Good night, all.
Thank you. Bye.
Bye-bye.